BigBear.ai stock is currently trading live at $3.50 during this intraday session, marking a noticeable upward move of 2.79% from its previous close of $3.405. Volume is picking up pace at over 17 million shares trading hands as retail platforms notice the action. But while most traders are simply watching the flashing green numbers on their phone screens, thinking this is just another minor daily bounce in the tech sector, something much more interesting is quietly happening beneath the surface. Institutional block orders have begun shifting patterns over the past week, signaling that large-scale buyers might be accumulating shares at these specific lower technical boundaries, completely separated from the retail noise. This dynamic sets up an immediate conflict between what the average casual trader sees and what the sophisticated institutional desks are executing behind the scenes. It creates a fascinating setup for anybody trying to navigate this landscape. When you pull up a chart for this company on common trading tools, the general expectation among retail participants is that this is merely a highly volatile penny stock that tags along with the broader moves of market giants like Nvidia stock, or gets thrown into casual discussion alongside heavy hitters like Tesla stock and Apple stock. The broad consensus is that smaller software operations are too risky to hold long-term, serving only as short-term trading vehicles for quick speculative plays. But the reality is far more nuanced. While the surface-level narrative brands this company as a speculative bet, a closer inspection reveals a deeply entrenched contractor that has secured dozens of millions of dollars in federal and national security backlogs. This structural baseline gives the business an enterprise stability that standard speculative software companies completely lack. The real story here is not about retail hype cycles, but rather about structural defense budgets and software integration that standard market indices often overlook. Looking closely at the recent price history, the stock has faced considerable downward pressure over the last month, sliding from highs near $5 down to its current territory. This slide has caught the attention of self-investing individuals who keep a close watch on high beta names through online investment platforms. During the high-volume sessions earlier this June, trading volume spiked past 40 million shares on consecutive days when the wider tech market experienced a broad rotation. This massive volume indicates that large positions are changing hands rapidly. When looking at data feeds from an interactive brokers platform or analyzing the order flow on a Fidelity trading platform, you can see a distinct tug-of-war. On one side, short sellers have been pressing their advantage as macroeconomic indicators fluctuate under a hawkish Federal Reserve backdrop. On the other, patient accumulation is happening near the 52-week low of $3.01. This tells us that while the short-term trend looks bruised, there is a clear valuation floor where institutional buyers step in to absorb the selling pressure. For anyone using a Robinhood app or managing a self-directed individual brokerage account, seeing an asset drop nearly 40% over a 12-month window can be alarming. Many people look for investment help or check online investing forums to figure out if a bottom is truly in. The broader macroeconomic environment has not been doing small-cap tech any favors either. With the Federal Reserve signaling a restrictive stance on interest rates for longer, high-multiple growth companies have seen their valuations compressed across the board. Investors who prefer automated assistance via a SoFi robo-advisor or Schwab Intelligent Portfolios generally lean away from individual names like this due to the sheer mathematical volatility. However, for active participants engaging in SoFi active investing or utilizing comprehensive tools like interactive brokers stock trading, these sharp structural dislocations represent unique windows of mispricing. When a stock falls rapidly on light news but finds a strong bid on massive volume days, it often means the weak hands are being shaken out by larger, more disciplined entities. Sector momentum has been incredibly fractured lately. While mega-cap tech stocks have held up the core indices, smaller data analytics and intelligent software providers have been cast aside. This divergence is visible if you track the movement inside specialized baskets like Fidelity ETFs or various thematic tech funds. Institutional activity reports show that large funds have trimmed their generic software exposure while selectively adding to specialized defense technology firms. This is where expectations part ways with reality once again. The public sees a tech stock underperforming the Nasdaq, but institutional desks look at the expanding backlog of government entities needing data verification. When you look at interactive brokers' fees and account structures designed for high-volume professional traders, the data shows an increase in sophisticated options positioning for this name, particularly in long-dated call options. This suggests that while the current spot price feels subdued, the smart money is quietly positioning for a multi-quarter recovery layout. To understand why this dislocation exists, we need to look at exactly what this company does and how its underlying business model operates. BigBear.ai builds artificial intelligence and machine learning software solutions that focus primarily on three distinct areas: global supply chain logistics, autonomous systems, and national security cyber intelligence. They essentially take massive, messy, unstructured data sets and turn them into clear, actionable, predictive models for decision makers. Unlike consumer-facing software firms, their primary clients are major government entities like the United States Army, the Defense Intelligence Agency, and large-scale commercial logistics operators. Their revenue model relies heavily on long-term, multi-year government contracts that feature incredibly sticky customer retention metrics. Once their software stack is integrated into a defense network or an international shipping hub, replacing it is exceptionally costly and difficult. This gives them a recurring revenue foundation that is fundamentally different from a typical cash-burning tech startup. If we review past performance and older financial reports, the historical numbers explain why the stock has been penalized by the market. In earlier quarters, the company reported revenue figures that were essentially flat year over year, with their first quarter coming in around $34.4 million. At the same time, selling, general, and administrative expenses showed a sharp upward trend, which naturally compressed their margins and resulted in a net loss. For traditional investors using standard criteria on investing sites or filtering companies through a basic fidelity brokerage screener, a negative net income and a negative price-to-earnings ratio are immediate red flags. They see the trailing 12-month revenue of roughly $127 million weighed down by substantial non-cash expenses and historical debt obligations. This trailing performance is exactly what keeps the conservative crowds on Robinhood Investments or those relying on a basic intelligent portfolio from touching the stock, keeping the valuation depressed and creating the current entry window for contrarian thinkers. Before we explore the future outlook and the critical catalysts that could completely shift this landscape, I want to hear your thoughts on this setup. Comment below how many shares of BigBear.ai you currently hold, or if you prefer to stick strictly to larger tech giants like Apple stock and Tesla stock in your personal portfolio. Let me know down in the comments if you think small-cap defense technology is worth the volatility right now. Looking ahead, the future outlook for the company relies on a very specific set of upcoming catalysts that could bridge the gap between market expectations and operational reality. The company has explicitly reaffirmed its full-year guidance for the current period, projecting total revenue to land between $135 million and $165 million. Achieving the upper end of this guidance depends heavily on the execution and scaling of recent contract wins, including a major deployment of their supply chain security platform in Panama's Dry Canal and ongoing counter-drone procurement programs with the military. If you watch market trends through sophisticated interfaces like the interactive brokers trading software or track order flow via specialized fidelity IRAs, these contract implementations are the key metrics to monitor. A single large-scale federal mandate can instantly add tens of millions to the top line, completely altering the current growth trajectory and forcing analysts to reevaluate their models. Of course, this potential does not come with distinct structural risks that every investor must weigh carefully. The primary risk is the lengthy and often unpredictable nature of government sales cycles. Deals can be delayed for months due to budgetary debates or administrative shifts in Washington, causing short-term revenue lumpy behavior that public markets absolutely hate. Furthermore, if the company continues to see elevated operational expenses without a proportional surge in commercial sector adoption, cash burn could become a lingering concern for anyone holding shares through a Robinhood stock trading or active SoFi investing account. On the flip side, the opportunity lies in their unique niche. As global defense priorities shift increasingly towards autonomous systems, video intelligence, and automated threat detection, the demand for specialized analytics software is hitting an all-time high. This is a macro tailwind that generic tech companies cannot easily capture, providing a protective moat around their core government business. To wrap it all up, the disconnect between expectation and reality on this asset is about as wide as it gets. The prevailing market expectation is that this stock is a struggling small-cap player, dragged down by historical net losses and recent sector rotations that have seen retail traders exit via their Robinhood mobile app or Fidelity Investments accounts. But the underlying reality shows an operation backed by a robust, multi-million-dollar national security backlog, clear full-year revenue guidance that